Tonight's lecture, the very first lecture on charting, is on chart construction, and our speaker is Ken Tower. Ken has been a practicing technician for more years than he would like to count. He's an analyst right now. He has been a member of the Market Technicians Association for, I think, more than 30 years. He was one of the first technicians to receive the CMT designation. He got that in 1991. We started offering them the first time in 1989. Mr. Tower is frequently guests on a number of the technical TV shows, including CNBC and Bloomberg, and you'll see his written comments in the Active Trader magazine, SFO magazine, technical analysis of stocks and commodities.
All right, welcome to lecture number 2, the history and construction of charts. Today we're going to go over 4 different types of charting technique. They all use the same data, but they all display the data in a slightly different way. And so we'll be focusing on the differences and benefits of each one. Although it's very basic, it is important to understand what you're looking at, since so much of traditional technical analysis anyway is looking at charts. And of course the reason so much of traditional technical analysis is looking at charts is because there weren't any computers, so besides the one in your head. So that turned out to be the best way to look at and analyze data. Apparently I got a defective water bottle. So in the beginning there was the line chart, which essentially is date scale on the bottom. This one happens to be every day, and you just take the close, typically is what we use, of each trading day, and well, if you were doing it by hand, you'd put a dot where the close is, and then you'd connect it to the next day's dot, and so forth and so on as you go along. And the advantage of this type of chart is that it's very simple and straightforward, and you know exactly what you're looking at, but you don't have to only look at these charts. If we go on to the next one, this is the same thing except it's a weekly chart. This is again just a line chart. It's taking the last price of the week for Disney, and I believe it covers the same time period as the previous chart. It just has a lot less zigs and zags to it. So if you just flip back, this one has a lot more detail to it. When you flip to the weekly, you see more the direction of things. And now if we flip to the next chart, this is just a monthly chart, the same time frame. So each one of these charts has its strengths and weaknesses. It's the exact same price data, but this one, the monthly chart, is much more jagged, but in some ways it's much more clear because it doesn't have all the little zigs and zags going on. So the line chart, very simple kind of chart. And the line chart is particularly good for illiquid markets or markets where you trust your data source less, but typically illiquid markets and really simple market, simple view of the market. The next one is the bar chart, and here we have 4 data points for each day now. This again is a daily chart. The open, the close are the 2 little horizontal marks. The open sticks out to the left, the close sticks out to the right, and then you have the vertical bar, which connects the low for the day with the high for the day. So again, it's the same The close here is exactly the same as the closing data in the line chart. But now you get more detail, more information. So just as the daily line chart had a lot more zigs and zags, more information to it than the monthly chart or the weekly, the bar chart now has 4 pieces of information each day instead of just 1. And the next one should be the weekly chart, and the next one is the monthly chart. So again, it's covering, well, the daily chart only covered about this much because the horizontal scale gets you only so many marks on the chart. So if you're looking at a monthly chart, you see a lot more history than if you're looking at the daily chart, but the idea is the same. You're getting the open, high, low, close for each period in question. You could also drop this down to intraday charts. You could do them 5 minutes, 3 minutes, half hour, hour, whatever time frame you want to trade, essentially. So if you're a very long-term investor, you're not spending a lot of time looking at a daily chart. It's just, for you, it's too much noise. If you're Warren Buffett and you look at charts at all, you're not looking at daily charts. It's too much noise. It's not the time frame that you want to trade or that you want to invest in. But if you're a day trader, you're not spending much time looking at the monthly chart. So depending on what your time horizon is and what your goals are, you can tailor your view of the market to whatever fits. So if you're an intraday trader, you're probably still looking at a daily chart just to get an idea of what yesterday or the last few days was like. And mostly you're going to focus on the very short-term chart. You might be looking at a 5-minute chart, a 7-minute chart. Everybody has their favorite charts. But price, in other words, is very flexible. And you can adapt it to whatever your purpose needs to be, whatever your strategy is that you're trying to trade. How you look at the chart, that is to say what the scale is, does have an impact on how you perceive the data. So when you have a price that moves a great deal from high to low, it can be valuable to look at the chart on one of 2 different scales. Depends on what you want to do. So here's Krispy Kreme for Cisco for 10 years. And you can see it goes from almost 0 to 90 and then comes back down to maybe 7.5 up to 25 and finishes around 20. So this nominal scale, which is just your normal scale, where everything goes by the same increment, 5 points, shows this as an enormous spike and collapse. A log scale shows it very differently. Why? Because when you buy the stock at, let's say, 2 in here, and it goes to 4 up here, you've made 100% on your money. That's the same as if you bought it at 40 and sold it at 80. So the log scale equalizes the percentage changes. And in that way, it can be very useful, because when you're looking at the price history, and especially as we get into part 2 of this class, which will begin the process of determining trends, this looks like a very clean, solid uptrend. And you can see the rate of ascent is pretty much equal across this whole multi-year period. If you go back one, okay, it looks very different. This part looks fairly stable in terms of rate of growth, but this part looks like a huge bubble. And so if we go back, again, forward one, right. So what we see here instead when we look on the log scale is that the price really had a very steady advance over a long period of time. There is the bubble aspects right here at the end, but it's much less pronounced in this graph. And where the stock goes to on the other chart looked almost like it matched its old lows. But on the log scale chart, right? It doesn't look that far off from down here. On the log scale chart, you can see that it did come down a long way from basically 90 to 10 or 8. That's a huge decline, but it didn't go back all the way to where it was in 95. So again, over a long period of time where there's a big percentage change between the range of prices you're displaying from low to high is really big, the log scale chart can be very valuable. If the stock trades in a range of 20 to 30 over this whole 10-year period, you don't need a log scale chart. Might be a little bit valuable because 20 to 30 is 50%, but it's not a big deal. So the less the range, the less you need a log scale chart. For a day trader, you do not need a log scale chart. There's no value. It only makes the numbers sort of screwy and hard to read. So for long term, though, if you're looking at a multi-year chart, whether it's weekly or monthly, the log scale can be very useful. Our next step in the evolution of charting is to take the same 4 data points that we used in the bar chart, but now we're going to highlight the difference between the open and close, and this is the Japanese style of drawing the same chart called the candlestick. The whole idea of the candlestick is the low and the high are exactly the same as the bar chart. The difference is that we're going to emphasize the difference between the open and close. Now, why is that important? Well, it tells you what happened during the day. So at the end of the day, you have sort of the same information you had, really you have the same 4 data points that you had for the bar chart. But with the candlestick chart, it's very easy to see whether the stock went up between the open and the close or whether it opened near the high and came down. And that has a lot to do with what happens the next day. So if you came out with earnings overnight, stock you're interested in comes out with earnings overnight that are better than expected, and the stock rockets up here and then spends the rest of the day selling off, what's it tell you? You're not attracting any new money on balance. Remember, what we're looking at, everybody's trading the stock. Short-term guys, long-term guys, everybody in between. People that run index funds just have to buy it if they get money into their fund, or they're selling it if money goes out of their fund. So there are 100 different reasons why people are buying and selling, and 100 different strategies. What we're measuring and emphasizing here is what happened on balance between the open and the close. And on balance, everybody said, wow, that's fantastic. We got this great earnings report. The stock was worth, let's say, 25 yesterday, and now it's opening at 28. Excellent. But what are the prospects going forward? The prospects going forward are, that's as good as it gets. Right? Because on balance, you didn't attract net new money. It went down from the open on. So this could be a higher close than the previous day, but if it was going down all day, that shows you that the news that drove the stock higher didn't produce additional buyers. And that's what you want to know. Because essentially, this is what price history does, and what charts do is they give you a window on what all the other people are doing on balance. Because again, 100 different strategies, 100 different reasons and time frames for why people are buying and selling. You want to know what your competition's doing. Because if you're the only one that thinks this is a stock is a buy, you're in trouble. Because here it is. You buy it here, great news, great earnings, blew away the estimates, and then it comes down the rest of the day. That is not a good sign. You should not be happy about that. You don't want to be the only one who thinks that the company's prospects are about to explode. You want to have company. You might want to be the first one, but you don't want to be the only one. So in any case, here are some examples. This first day, the stock opens at 23. It goes up as high as 26. It trades as low as 21, and it closes at 25. So on the bar chart, you'd put a little left-hand line for the open, and you'd put a little right-hand line for the close, and you'd connect the high and the low. That would get you the bar chart. In the candlestick, we close in this area. This is the close line, is this right-hand tick, but now we're going to lengthen that all the way across. We're going to lengthen the open line across, and now you get your color convention. In the old days, you had white paper, so it was easy to, in a case where the open was lower than the close, so in other words, the stock went up during the day, it was easy to just leave that blank. So traditionally, a white, this is called the real body, as you can see. The real body, you would leave it white if the close is higher than the open, and you would color it in black if the close is lower than the open. Today's software, you can make it whatever colors you like. A lot of people are very like the traffic light idea. So this one's green and this one's red. It doesn't matter. If you're colorblind one way or the other, just make it two colors you can see. Very straightforward. But the idea is that this communicates more easily the same data from the bar chart, but it visually is more appealing. It sort of jumps out at you. So the second day you open at 26, trade up to 28, that's here. You trade as low as 23 and you close at 27. Now we get into some special cases. You open at 26, your high is 28, your low is 23, and you close at 26. So that's closer to this one. And then the number 5, 27, 27, 25, 25. So you open at the high for the day. And I don't see that one on here.
No.
Okay, sorry, that's down in the box here. That's these, not these. Sorry, I was looking for them up there. For the first day, you open at 23, you close at 26. The high is 26, the low is 21, 25. You have in other words, you opened at 23, you closed at 25. You end up with a white real body. The next day, you open at 26. You close at 27. The high for the day is 28 and the low is 23. So again, you have a white body, but it's now much more narrow. The third day, you open at 23. So here, you go up as high as 27, but, so in other words, probably early on, you open at 23, then the stock trades higher all the way to 27. But you come back to 22 and that's where you close. So in the middle of the day you had a nice rally. The second half of the day you sold off hard and you closed right down at the low. Day number 4 is where you open and close at the same level. These are specialized patterns because you can see that the shapes of the real bodies and their placement in the range of high and low changes. So these different shapes all have names in the Japanese candlestick charting. It's very colorful, and this one's called the doji. So over the course of the day, the stock went much higher and much lower, but at the end of the day, people were willing to pay exactly what they were willing to pay at the beginning of the day. So basically, although you have a big up and down in the middle, you have no change. You have supply and demand imbalance for the day. And then on the last day, you open at 27, that's the high for the day. You close at 25, that's the low for the day. So basically, when you're looking at the charts, the black real bodies are bad news. And depending on exactly what the shape is and how they occur relative to the other things that you're looking at, because you don't use candlesticks, I think, only by themselves. You use them with many and many other tools. You can get a better idea than just looking at the bar chart where things are headed based on how they acted that day. So now we're going to look at Krispy Kreme, daily candlestick chart on Krispy Kreme. And basically, the substantial white real bodies take place during rising price periods, and they're a good thing to see. If you own something, this is exactly what you want to see. You want to see it start out low and attract money all the way through the day. So that's what you see here. That's what you see here, 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 here. Once you start getting to the black real bodies, remember, you close at the high for the, well, very close to the high for the day here, because it's a white candle. That means the close is higher than the open. So the top of this real body is the close of the day. The next day you open higher. So you're still thinking, nice, you know, if you're long the stock anyway. You're thinking, nice, this is just what I'm looking for. But then over the course of the day, all it does is sell off. So in other words, it's telling you something about about demand and supply. And then the next day you have one of those dojis where, again, stock price opens higher, because here's the close on the black real body. The close is at the low of the real body. So the next day the open is higher, so you come up, but then you can't go anywhere. And you end up flat for the day. The next day, again, you come up on the open, but then you drop down. The next day you do drop from close to open, but again, you can't make any upside headway. The following day you have a big intraday rally, but you lose it. Not quite all of it, because it's a white real body, but you lose most of that rally during the day. So again, these are all signs that the market stalled. And then once you start breaking down below support, which we'll get to in part 2, you're not sure you want to be long anymore. And as you'll see in the downward phase, there aren't many white real bodies. And there aren't any big white real bodies. So again, this is exactly the same information on this chart and the candle chart we just looked at. Exactly the same. The only difference is that the opens and the closes are not connected and filled in here. So you can see the difference in perception. This is exactly the same data, but when you look at the candlestick chart, immediately you get a different idea of these big white candles showing you a lot of buying interest during the day. It's not that every single day fits in. It's just that at a turning point, the candles can help you to distinguish the turning point. And what's, of course, driving this at the bottom is all demand and supply. So when you have an imbalance in supply and demand, that's when you get a trend. If supply and demand are imbalanced, stock trades at the same price all day long, all week long, all month long. Then somebody's going to change their minds. Maybe the company releases some news that their sales are better than expected, or earnings are better than expected, or worse than expected. And now the price isn't staying at the same level all day long. So what we're trying to track with technical analysis in general, and with these types of charts in particular, is who's got the imbalance. Is it the demand that's more than supply, which gets you these big white candles, or is it the sellers that are overwhelming the buyers? Because there's a buyer and seller for every trade. So it's not that there's, you know, the old saying, there's more buyers than sellers. It's just that the sellers want to sell more than the buyers want to buy. You get that. And the big black bodies obviously are great helps. You can, of course, integrate that with the volume. We didn't talk about volume yet, but on most charts you can see the volume, and in general it's considered a very helpful tool, so that when you have a big up day, when you're just coming out of a period where you went down and now you're turning up and you have a big volume on that up day, it's said to be a good thing, better than a light volume day, because again, not only is the price going up, but you have obviously more shares being purchased. And at the same time, here you're coming down, 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 and then you get this huge volume day, and this is not quite a doji, but it's very close. In other words, stock's been getting crushed from 9 to 7, so it's down 20% over this 1 month. And now all of a sudden you have this huge spike in volume, yet the price doesn't go down. Because remember, the close is at the bottom of this candlestick. The price is the same as the previous day. There's a huge amount of shares traded. What does that tell you? Buyers and sellers matched each other that day. In other words, the buyers were willing to step up and absorb all the selling that was coming out. So these, again, can be very important reversal days. And this looks like a test of that low. And again, the volume is quite high. So volume can be a very useful tool for helping analyze the price pattern. Here's a daily candlestick chart. Candlesticks you could construct on a weekly chart, and you can construct them on a monthly chart. It's the same 4 points as we saw on the bar charts. But typically, they're constructed on the daily charts. They're most common on the daily charts anyway. And if you are looking at the Dow or the S&P, you'll need to do candlesticks based on the ETFs that mirror those indexes because they don't calculate the opens properly. So if you look on a chart of, say, the SPX, there are very few gaps because stocks don't open all at the same instant. So they use some old prices from the day before and some new prices from the current day. And so the open on the $ SPX chart is almost always the same or very similar to the prior day. If you look on the SPY or the DIA or the QQQQ, it's never, well, it's rarely the same as the previous day. So if you're looking for gaps, and of course this influences the size and shape of the real body, so it's really important. If you're looking for candlesticks, you don't want to look at the indexes themselves because of the way they calculate them. Look at the ETFs, and you get a better idea.
ETFs are exchange-traded funds. They're like mutual funds that are listed.
Again, here's the Dow, and what we're seeing is a lot of sort of congestion when you're up here at the top. You have what looks like a really good day, big white candle to a new high, or we don't know exactly what's before this, but looks like a new high, and yet the next day can't make any headway, and we close sort of in the middle of the range, but a long way off the open. The following day, again, remember this is the close, so you gap up in the morning, but then you come down most of the day. You have a decent day the next day, but you don't get above the previous high, and there's another big red candle closing at a lower level. So all of those solid red real bodies, again, are telling you there's more sellers out there, or there's more shares for sale than there is demand for shares, and the price is coming down. Then you have the collapse day, and the next day you open down here. So that's a big decline on the open, but again, that's where things start to change. And by the end of the day, you're significantly higher. You have a relief rally back up to about the point where you broke down, and then you roll over again. So it's not that you only need to look at candlesticks for the rest of your life. It's just that they are a very attractive form of charting that highlights the differences over the course of the trading day and are visually much more appealing. Now, everything we've been looking at so far has a standard horizontal time scale. Days when the market is closed are omitted, but every day the market's open is marked on the bottom of your chart, and it's very regimented. Each day has the exact same amount of horizontal space as the day before. Doesn't matter whether the volume's high or low. Doesn't matter whether the market was only open for a half day. Each day is given the same amount of space.
We saw advantages here because they jump out at you, whether they were good days or bad days. But because they have width, breadth, you can't put that many candles on a page, so you cannot look at a lot of data with a candle chart. not nearly as much as if you were looking at a bar chart or a line chart. So that's one of the disadvantages of a candlestick.
Stock charts, by the way, has a lot of good free stuff if you're looking for charts. And for not very much money, you can move beyond that to where you can save your chart layouts with just the indicators you want, save a list of stocks that's just the ones you want to look at, and do some screening stuff. So it's a great place to start. They have very comprehensive encyclopedia, I forget what they call it, chart school or stock chart school, something like that, where they describe in detail all the various indicators they offer, exactly how they're calculated, and a lot of information on charting styles as well. So it's a good place to start if you want to play around with the charts. So everything has a daily scale, a weekly scale, a monthly scale. If we had hourly charts, they would also be on a very clear, clean to read horizontal time scale. Now we come to point and figure charts, which are not based on time. So the horizontal scale now is, it's sort of loosely based on volatility, but it's a different kind of volatility. The point and figure chart follows pretty much only the price changes that take place. Time is not a factor in making the chart. As long as you're moving in the same direction, you stay in the same column. So let's say our first day here is, this is a $1 box size. So there's two things you need in point and figure. You need to know what the value is of each box, which you set depending on what you want it to be. And you need to know how many reversals you're going to look at to, how many boxes a direction change needs to be before you're going to recognize it as a significant change. So the advantage of point and figure is, now I'm looking at, this is a $1 box size. So anything that's less than $1, I'm not paying attention to. So we start out, looks like 62. So we start out at 62. Now in this case, this stock went straight up from 62 to 75. Nope, sorry. It looks like about 78 without dropping by a point. So you just stay in this one column because it's a one-directional move. One directional based on $1 price increments. Point and figure charting is the oldest form in the United States, probably developed in the 1870s, first written about by some of the early guys like Charles Dow around 1902. Some people called them points, some called them figures. They had different styles. But by the 1930s or 40s, this was the dominant form of charting. Then, as computers come along in the 50s and 60s, the programmers need a nice, easy-to-define database to store the numbers, and that's where the daily data starts to come in, because now every day, if I'm a software guy, I know exactly how many bits I need to record the day's data. For the open, I know how many bits that is, for the high, for the low, for the close. With point and figure, once you get into these periods where the price is going up and down, you're not sure. On a crazy day, you could have lots of different changes in direction. On a boring day, you won't even make one posting. So the database for the original point and figure charting is very hard to, well, it was very hard to contain when you had limited computer resources back in the early days. And the software has just kind of evolved from there. So point and figure charts didn't make a good jump into the computer era. That's not to say that technique is not valuable. It's just not readily available. So in any case, runs from 62 to 78 without dropping by a point. Then it drops to 77. Now, if you just put the X right on top of the other X that's already at 77, you won't have any idea where you are. So when you change direction and you would have to write over what you've already written, that's where you move over. In this case, it drops just the 1 point to 77 and then back up, 79, 80, 81, 82, 83. Then it comes down 5 points, up 2, down 1, up 1, down 1, and then up another huge run. This move higher or this move higher, you don't have any idea really how long those took. That could be 1 day's trading. Stock comes out with great news. Or it could be several months. On this chart, there isn't any. The only time markings are the year, 2007, 2008. Depends on whose point and figure charts you look at. Some people put in the months or even a solid red box for each, the open for each day if you're looking at very short-term charts. Older point and figure charts would have perhaps a number for each place where the month comes in, because people are interested in the time, but time is not a factor in the construction of the chart. So as long as something's going up, whether it's for 1 day or 5 months, you just stay in that same column because that's the direction. That's what you need to know. What's the direction of the stock? And in this case, it's moving up. Then it goes through some consolidation where it's choppy back and forth, and then there's another big move. A more significant decline, another advance, just a $1 drop, another advance. So this tends to condense the price history into tighter visual display. This is the same $1 box size, but now we're not going to pay attention to those 1 box declines. We're only going to pay attention to a decline when it's at least 3 boxes. A box is $1, so $3 declines. And this is a very common form of charting now. Was invented in the 1940s, and basically the Chartcraft charts are drawn in this style. And the idea was that for people that didn't have a good data source, you could create these charts with just the data that's in the newspaper, in other words, high, low, close. You could keep some of the valuable things of point and figure chart, but you didn't need every tick the way that the original method required. So you lost some of the detail, but you were able to retain the most valuable parts of the point and figure chart as you went forward. So now, again, we have these big moves higher, and we have even more history. The other chart we saw was approximately this area and had 2007, 2008. But by eliminating the smaller reversals, we have an extra year worth of chart. So essentially, when you're looking at a point and figure chart, there's 2 things that you vary: the box size, or the number of points or the number of boxes that you need to recognize a reversal. In the same way that if you were a short-term trader, you'd look at a daily chart, whereas a long-term trader looks at the monthly chart. Here, you'd vary the box size and the number of reversals in order to either really focus on the short-term trading history or take a long-term view. So this is a fairly long-term chart. As you can see, it's got 3 years worth of data on it, and so obviously it's not a short-term trader's chart.
What Mr. Tower is saying, if you didn't catch it, is you really, to create a point and figure chart, a real point and figure chart, you need to know every trade. When you're making a bar chart, you only have to know the open, high, low, close. But you really need to know every trade, because in theory, it could go up and down in a couple of point range a dozen times during the day, and you'd get a dozen reversals. This chart we're looking at here can be made without going through that. But a real point and figure chart, you really need to know every trade. And in fact, that's the reason that these charts came to be, because specialists or traders on the floor trying to keep track of their stocks couldn't create bar charts, but they could make point and figures. That's why they did it. It was very easy to keep track of what the stock was doing.
Actually, for a long time, even into the early 80s, because there weren't any handheld computers, the guys in trading stocks and futures in the pits, they would hand keep this type of chart because it's easy to do. Of course, they would not be doing, well, if it's a very high-priced stock, perhaps they'd be keeping $1 box sizes, but probably if you're the specialist, you're keeping a 25-cent. In the old days, each trade was an eighth, so 25-cent box size, or maybe you had a 50-cent as well, and that was how you kept track of what the prices were doing for the day. Because again, you're trying to decide where's the imbalance, or is there an imbalance between buyers and sellers, and the charting of some sort is easier than remembering all the prices of the day, and easy to see visually very quickly. So point and figure was originally traded or used especially by specialists. Then I think the book says Thomas Edison patented the ticker tape, and all of a sudden, boom, you had this huge expansion of trading. Because now anybody that had a ticker tape machine could tell what the price was. Before, the only way to tell what the price of something was to be at the exchange. Now, with the ticker tape, there were brokerage offices where you could go to see the ticker tape, or you could have the ticker tape in your own office, and you could keep track of these changes by hand. And again, as Professor Roth says, it's way too much trouble to write down everything, every 5 minutes to write down the price. It was just much easier to just keep track of the direction of the price. Is the price moving up, or is it starting to move down, or is it moving back and forth like crazy? The back and forth tells you supply and demand's pretty much in balance. Buyers push it up $1, and the sellers push it back down $1. And then it tilts a little bit back and forth the other way. So each of these things tell you some important information. Go on to the next one. This is the same chart, but now in that last example, the box size was changed to $2. So again, a longer term chart. By going to a $2 chart, you're getting more history, and at the same time, the next chart goes to a 3-box reversal, so you're eliminating a lot of the sideways action. And again, for sort of a longer term trader, this chart still has a lot of information. Because if I want to buy this stock and I see that it's going up, I'm just holding on to it. As long as it's going up, I'm pretty happy. When it starts to go down, and there's all sorts of rules in the 3-box reversal method about how far down something can go before the direction starts to change, and what are the action points. And they're very well defined. So the 3-box method is really a simplified method, and that's what you'll find most point and figure charts are going to look like this. Because it's simplified, it's easy to program. The database doesn't require anything special. All you need, remember, the simplified method was made for people who only had a newspaper and didn't have a ticker tape. So all they knew was a high-low close for the day. Boom. That is what we're trading here. So it's a simplified method, but it still can be valuable. Here's the S&P spiders. And this is a shorter term chart. This is again from stock charts, and you can see that besides just the year, they also have the month listed. So the number 1 is the beginning of January. Pretty sure that's 2010. Yeah. So here's January. Here's the February decline, or most of January, and then early February. I don't know. That says 2. So that's February, and that's March. There's a lot of volatility here. Look how tall the each individual column is of data. People are going nuts. They don't know whether they're buying or selling. And there was a lot of angst, and nobody has any conviction. And you can see it in the trading. Then as things stabilize, now look at the bars. They're maybe 5 tall as you start to go up because everybody calms down. So one of the big advantages of point and figure, because you move to the right every time you change direction, it's got a volatility adjustment kind of built in. Because the more volatile things are, the faster you move across the chart. The bar chart moves the same amount every day. So you can often see patterns, they kind of explode or they just appear even in a very short period of time, especially when volatility is high, because with the point and figure chart, that don't happen in the same way with the bar chart. So that's one of the big advantages. It's a disadvantage not having that nice, easy to read time scale, because that's the way you remember things. You remember things by the date and what was going on. But you can get used to it because you can see they have the months listed here. There's March, and here's April, May, June, July, and then August. So in some software, they have the dates pretty well marked in. In others, it's not so good. So it really depends on where you look. As I say, point and figure charts online haven't evolved very well, although Bloomberg's done a lot of work in the last 5 years, really. I guess probably 2 or 2.5 years ago, they did a lot of work upgrading their point and figure charts. I know, because I worked on it with them. But they're pretty good now, and I think you can switch to a log scale there. You can definitely switch to a log scale on the stock charts, P&F charts. Schwab and their active trader thing, Street Smart, also has some decent point and figure charts, and those are the 3 that I'm aware of. I think TradeStation's pretty good. Haven't used them on Fidelity's. So there's a lot of point and figure charts out there. The software designers have gotten kind of bored with the indicators that were out there, so they needed something. They finally got around to point and figure. But the database still isn't exactly what you need. If you use the smallest database possible, so if you're looking at, say, 10-minute intervals, well, I mean, a tick data chart is every trade. But essentially, if you're looking at a 1-minute bar chart, if you use that data to construct your point and figure chart, you're not going to miss too many things. There aren't too many big price changes that happen within 1 minute. So it's a question of how many days of the smallest possible price increment you can go back, how accurate your chart's going to be. But for longer term charts, if you've got basically even hourly data, your chart's going to be pretty good. Not perfect, but pretty good.
What do we not see on this chart that we saw on candle charts and bar charts that was useful? There's no volume, and it's very hard to construct volume. It could be done, but that's correct. What else? Well, you can't tell the daily range, right? You don't know what happens. You don't know what happens one day to the next. That is also correct. There are no gaps either. There are no gaps on a point and figure chart. There would be gaps on bar charts and candle charts. So the disadvantages, or the things that you lose, would be volume, gaps, intraday volatility. You can't tell one day to the next, intraday volatility.
Right. This does say 09, by the way. It's clear in the...
Really? That's a 9?
Yeah. Yeah.
Okay. Well, that's good.
So that was a... Okay, that's a 1.1 box reversal. Now, the next chart is the same 1 box reversal, but now it's 2 points to a box. So it just makes... first of all, you get a lot more history. Now we're going back to 2008, and this is the very end of 2007. The stock charts runs out of numbers after what? September. So then they go to ABC for October, November, December, because they don't want to fit 2 digits into the box. So here's the beginning of December, and here's the beginning of January 2008. So by going to 2 boxes, we've now expanded our view. We're taking a longer-term view of the market. Here's that crazy period in 2008. Yeah, 2008, near the end of 2008, and here's the decline to the low in March 09. Stock charts uses the sort of revised convention of whenever there's a downward posting, they make it an O. So any posting that goes up, they make it an X. Any posting that goes down, they make it an O. It's supposed to make it easier to visually sort of read the data. I don't know if it does or not, but it's a common convention anyway. And it was really started again by the guys at by Abe Cohen back in the 40s. And it's definitely clearer on the 3-box reversal stuff, because on the 1 box you can have an X and an O in the same column. So in other words, here in this column, you're coming down to the beginning of July, and then you go up 1. So because it's an up posting, they make it an X. But the next one's down, and then it's up again, so it's an X. But then the next 2 are down, and then it's up 1, down 2 again. So it's not quite as clear. And when we used to do them by hand, we just used all X's, because it was just easier to make an X than an O. You could make the letters for your initials if you want, whatever. You know, it doesn't matter what you put in there, just like it doesn't matter how you color the real bodies in the candlestick charts. As long as it works for you, it's good. Now, here we have the same chart, but now we've increased the box size to $3. So now we're going all the way back to 2001. And you can see the triple bottom in 2003. Now, one of the really nice things about point and figure charts, because you're only going to plot a determined amount, the bottoms and the tops are often, they kind of jump out at you. Whereas on a bar chart, one of these is going to be slightly lower or higher than the other. They aren't going to be really even the way this is. On the top isn't going to be really even the way that one is. So the point and figure chart, by trading in a fixed increment, often helps you to recognize support and resistance zones, which we're going to get to next. You also notice that the years are plotted down here at the bottom, and you can see very clearly now that 1 year does not occupy a set amount of space. The more volatility there is, and by volatility we mean changes in direction, the more space the year is going to take. And so you get this top forms this is 1 year. And you can see that 2007 occupied the same amount of space as the previous 3 years. And then 2008 was a monster. Again, so there's a volatility element that's adjusting constantly with the point and figure chart. And that also is an advantage of the point and figure chart, because on the bar chart, again, every day is the same. And on the point and figure chart, the more exciting areas where there's a lot of back and forth between buyers and sellers, that really gets blown up. And it's easy to emphasize. So that once you break down out of one of these sideways zones, the larger the sideways zone, the more significant it is. And once you break out of these, you get a pretty clear idea that you either want to be in it, like here, or you don't want to be in it, like here. And remember, the news is always going against you. The news at the bottom is always terrible. The economy stinks. The world's coming to an end. No one's ever going to want to own a dollar again. You know, it's the same thing at every low. And at the top, life is good. We have a new prosperity. It's the same thing at every top. So the whole idea of technical analysis is that although there are a lot of subjective elements to it, especially with candlestick charts and point and figure, bar charts, there's a lot of subjective elements to it. There's also a lot of objective elements to it. Once you're coming down here, you can't make that into a good thing. And the same thing, when you come up here, and this is March, February, March, April of 2002.
The bottom? March?
Yeah, sorry, 2003. And you start to pop up out of there, you can't make that into a bearish thing. It's just, there aren't any rules in the technical analyst's toolbox that make this a bad situation. So no matter how convinced you are that the economy is about to die and has already been mortally wounded, or how convinced you are here at the top in 2000 or here in the top at 2007 that prosperity is here to stay and we've discovered the Holy Grail, once things start to go down, it's in your face all the time. If you own something, because it's very easy to hold on to something that starts to go down. Psychologically, you want to sell it when it goes back up. So you're holding on to something. First of all, this has stopped going up. And now it starts to come down. That's objective. Exactly where you're going to pull the trigger, pull the plug on some investment that you've got, that's a matter that'll change from person to person depending on your strategy, which techniques you like, which ones work the best for you essentially. But you can't make that into a bad thing. And you can't make this into a good thing. And so in that way, the objective nature of the technique is telling you, hey, something happened. You may not understand what happened, but something happened, and the prices are going against you. And again, this is these prices are just the macro of everybody out there. So if you think that everybody's bearish because all day on CNBC all they talk about is something horrible, or every article in the journal is about how the economy is down, the unemployment's terrible, people are losing their jobs, unemployment this, that, and all of a sudden the stock starts going up, or in this case the S&P, something's happening that you don't maybe understand, but the price action is telling you it's happening, and you can see it in the charts. Same thing here. The economy's awful in this period, 2000, 2001, 2002, October. 2001's out here, sorry. This is October, this is December, and this is March of 2003. So the economy's awful throughout that period, but stocks have stopped going down. So even before it actually starts to go up, it's telling you that things are changing. And pretty much the same thing here. Here's the peak in 2007. That looks like July. And then there's a lot of volatility in August. You have a sharp decline, and then a lot of volatility into September, October, November, December. You've stopped going up. So again, newspapers are great, full of great stories. Everybody's beating their earnings. Life is good. And yet, the market stopped going up. And pretty much the same thing down here, although this one was a little tougher because in March it did go to a lower low. It was kind of an exhaustion low. But if you can recognize it, and I guess this is one of the valuable things too, when you do get a bad signal, you can tell it's a bad signal. You don't have to wait until 3-4 months later when the next round of earnings comes out. You have rules that tell you, okay, all right, this went to a new low. I think it's going down. I'm very bearish. The economy's awful. The news is all bad. I'm short. Stock starts to go up. Now at some point, depending on, and we'll get to trends in a minute, but depending on how far this rallies, at some point you're saying, okay, this was a bad signal. I'm not happy about it. I'm losing money, but it's better for me to lose this amount of money than this amount of money. You keep yourself from blowing up. You could look at this one too. This goes sideways here and pops out to a new high. That's April of 2009. And you could say, wow, that's pretty good. This looks like it could keep going up. There's an old top here, but it looks like for the moment it could keep going up. So you buy something. As soon as it starts coming down, gets back down to here, you know it's not happening. So it's not that the signals are always right, but when they aren't right, you can tell they aren't right. You don't have to crash your portfolio before you know that you ought to change direction and look for something else.
Another way to express what Mr. Tower was talking about is that bottoms are made by people that are willing to buy in adversity because they think the bad news is in, has been discounted, or is mostly in and mostly discounted. And they gingerly come in. And ultimately, they're going to be absorbing the selling coming in from the people that don't believe it, and things turn around. And the top, of course, is the opposite. People they're going to take profits amidst great news because they made a lot of money. And when that kind of selling picks up, it's going to reverse the trend. So bottoms made by people that are willing to buy in adversity. Tops are made by people that are willing to sell in good news because they made the money. Doesn't mean that they're always right. Sometimes it takes a long time to turn around, but that's what's going on.
Yeah, go ahead.
Just a quick question. Could you just run through a couple? I'm having trouble seeing the figures, so I'm just trying to interpret what this is telling us here. Could you just run through like a couple lines?
Right. Okay, so here you're at 47.
Right.
It's
Daily, 3 points per box. Any advance or decline, 3 points or more.
right. So you're tracking, every box is 3 points. And you're tracking every one box reversal. So basically, you're going to track every 3-point move.
Right.
And so you start out at 87, right there. And you go up to 90, 93, and there's October of 2001. So you're coming out of 9/11. You go up to October, and you get up to the peak there, which is 99. Then it drops 3 points to 96. So you have to move over a column to avoid putting an O on top of your A, and then you won't be able to read your chart. So you drop down one and move over. But
let me interrupt again. We know that you're not going down. That O is in what, 94? Is that where it is?
96.
96. We know we could have gone to 93.05 because you need 93 to get the next tick. Understand?
Right. Right. So when you're here at 96, unless you trade at or below 93, you're not putting another thing in there. And what happens is before you get to 93, you trade back at 99. So you go back and match that high. Then again, the S&P SPY falls down to 96, but does not fall anymore to 93. So it's at 96, then 99, 102, 105. And that is C. Sorry, this was B. That's November, and that's December.
And that could be 107.99, remember. You need 108 for the next tick.
Right. So the C here is at 105. It does not trade at 108. Comes down to 105, but does not come down 3 points more to 102. So comes down to 105, then back up to 108 in January of 2002, and then down 6 points, up 6, and then it starts where you really start to see much more downside action in 2002. That was after that March rally, and you came down in April, and you just kept going down until the end of July, which is down here.
Okay, thank you.
Sure.
Remember, you are deciding how many points per box and how many boxes per reversal. You are deciding that. You're deciding it because of your time horizon, because of the price of the stock, how you're making that decision. And of course, you could, over time, you could change it if need be. But
Right. So again, this is a fairly, well, it's got almost 9 years of history. So it is obviously a long-term chart. And the top up here is kind of scrunched up because you need the higher scale. So you have to use the the 3 points. If you put this on a log scale, it would have the effect of making this early 2002 look like a bigger congestion zone.
No, I guess I was confused around the red number, because feasibly you really could go month to month without having anything. If it doesn't advance or decline, move within a 3-point range.
Exactly.
So it's, I guess I was just looking at the frequency of month to month.
Right. So with point and figure, it's very much a directional signal or directional tool. And the trend, this is May, that's 5, June, and then it goes to September and October. So in other words, in this one box of 3 points, right, that's May, that's June, and that's September. So that is, let's see, June is price level of 90. So for June, July, and August, you stayed between, you didn't drop down to 87 and you didn't get up to 93. So you had a very tight range without much, almost no volatility. Because you had so little volatility, it doesn't show up as anything on here. July and August are contained within those 2 boxes, essentially, and a 6-point range. So it condenses a lot of the really smaller activity. And then at other times, like here, it's a long way in between. It's a long way in between months. This is the beginning of August right here, and the beginning of September is up there. So all of this was in 1 month, whereas here we have 3 months all in one box. The point and figure charts are very different than the other 3 types of chart we looked at, and they have a lot of advantages. But mostly you don't find volume on them, so if volume is a key tool for you, you have to look somewhere else to get the volume. The next thing we'll do, again, the old-fashioned point and figure charts, it was too much effort, basically, to construct even a simple indicator like a 10-column moving average. With the other 3 types of charts, you want a 10-day moving average, you just average the prices for the 10 days. 10-week moving average, you take the last 10 weeks, average them out, put the dot. Point and figure, because it works on columns, you have to take sort of you decide whether you're going to use the high or the low or the average of the column, which I think is the way to go. Use the average of the column, and then you average it over 10 columns. So it works in the same way, but it's different because, again, you're not basing the chart's not based on time. For those of you who have used moving averages on any other chart, you can see that they work in approximately the same way. How do you decide what length moving average to use? It's pretty much just like with any other kind of chart. It's just what you want to look at.
We'll get into that in further lectures into more detail. Depends on how frequently you want to trade, how much, and whether you're a trader or an investor is going to make the difference.
It's like the question that you'll get on which type of smoothing is the best for your moving average. And there isn't any clear answer. It's pretty much these are all just tools, and you're going to try and put them together into something that makes sense for you. I personally just use 10, 20, and 50 because I don't need to make the chart more complicated than it is already. And I don't really like to backfit the data by telling the program to, the software to try and figure out whether an 11-column moving average is better than a 12 or a 10. That level of precision, I think, is imaginary, and you just get yourself in trouble because you think you've got this great system and then immediately blows up. So I just use 10, 20, and 50. 10 and 20 are round numbers, and 100 is too long, so 50 is the next one I use. But if somebody wanted to use 10, 20, and 30, I wouldn't argue. You know, all the smart guys, if they think you're using that, basically everybody's using a 10-column average, we'll go to a 9-column average. Just like if they think everybody's using a 10-day moving average, they'll use a 9-day moving average. So to try and get signals just a little bit better. That's good. I don't like Fibonacci numbers either. So that all works for me. Next chart. So there's one moving average. Here's two moving averages. I mean, these are just the basic building blocks. There's nothing fancy about these except that until, I don't know, not too many years ago, it was just very unusual to ever see moving averages on a point and figure chart. Again, the idea here is you're trying to figure out where the imbalance is between buyers or sellers. And the moving averages are just smoothing out the data for you to show you that underlying trend, which is what we're going to talk to. The next one is Bollinger Bands. Oh, no, it's not. Sorry. It's my 10, 20, and 50. So now we got the three moving averages on here. And the last one, nope, this is still, I guess we've gone to a two-box reversal here. So again, if you want to zoom in on the data, you look at a two-box. If you want to zoom in more, two points per box, so $2 reversal. If you want to zoom in some more, you would drop it to a $1. If you want to zoom in some more, drop it to 50 cents, 25 cents, 10 cents, 5 cents. I wouldn't go lower than 5 cents, but whatever time frame you want to trade. The idea is that the position and direction of the moving averages help you to, again, objectively quantify what the direction of the trend is.
And we'll go into that in detail in subsequent lectures. Yes, you can build trading models around moving averages. Take a look at this chart here. You could say I want to be long when I want to be short when the 10-day is below the 20-day, and they're both declining. Look at that simple little rule. Look what it captures.
You know, you have the long-term 50-column moving average is the green line, and essentially when the prices are above that, you want to be long-term bullish. When the prices are below that, you want to be long-term bearish. When the prices fall below the two shorter-term moving averages, again, these are all simple rules, but for every portfolio manager, you have to avoid getting blown up. No matter how good you are, you talk to some guys, and the difference between having a great year and having a good year is 1 or 2, maybe 3 trades that blow up. And by using an objective measure, you can not get every single thing right, but you can avoid the explosions. The ones that kill your performance, you should be able to avoid, like this. All right? I mean, you can't make this into anything good. Let's say we don't have any idea where prices are going, and we're looking right here, which is, I don't know, I guess that's September of 2008. And so we've got some stabilization, right? Here's July. We made a low in July. August, we're coming up. September, we're coming back down, but we're still above the old low. It's okay, but it's not good.
And all the moving averages are declining.
Right.
And the 10-day is below the 20, and the 20 is below the 50.
Right.
That, by definition, the trends are down. So there's just almost no reason to be long at that point, unless maybe you're scalping a point or two. But anything beyond the shortest horizon, you wouldn't want to own that by that simple rule of these moving averages.
Right. The guys who are buying here are the guys who think the valuations are cheap. Or if they're using technical tools, they want to be heroes and be able to say to all their friends that they were buying near the low. But there isn't any reason to go long at this level unless you're a speculator or a value guy who thinks like that prices are cheap. And this is, of course, the big problem with a value approach. You can often identify when things are cheap, but you may not get it right as far as them not going further down. And very often things that are cheap tend to get cheaper before they turn around and go up. If this was an individual stock. And in this case, the market was already down a lot from its high in 2007, but it was going sharply lower. Then you have stabilization here, but again, the 10 column never crosses above the 20. You do have a couple of times when the actual price gets above the 10, and once where it gets above the 20, or maybe here. But it's not until you get over here into, well, that's March, so, and that's May. So it's not until you get into April, this is April, that you really start to see a sustained improvement, and finally you get a crossover in May, and now at least you're above the 50 column average. So these are very simple and simplistic rules. It's a starting point, but even with the simple rules, you don't blow yourself up. And when the market starts to go up like crazy, which is the next chart,
Let me just add one thing about this one. You're not going to get out at the high tick, and you're not going to get in at the low tick, nor are we even trying to do that. We're going to sell when we think the odds are in our favor to make money on the short side, and we're going to buy when we think the opposite, and we don't care where the low is or where the high is. Well, what we do care is, do I have a trend that I can count on? So, you know, there are going to be people that are saying, you guys missed the low in May of 2009. But look what we didn't miss in 08.
And now if we go, the next chart is just sliding across, and I think it's pretty much where we started to begin with, $1 box size and all this huge volatility in 2008. But now I think it makes a little more sense than the first time we looked at it, because we know that we're below the 10 column, we're below the 20 column, and we're always below the 50 until we get to April. Now we're seeing some real improvement. The 10 column has been coming up. It's crossed the 20. We're above the 50. And so now, again, all the news still is awful. You can go back, you know, look at the headlines for the Wall Street Journal in April of 2009. It's not like there's any good news out yet, but the market's telling you this is totally different than this. All these rallies that you had, these are big rallies, but all these rallies went nowhere, and now you've changed things around. And we talked about in the first chart, we talked about, look at the huge volatility in these huge rallies going way up, way down, way up, way down, and now everything's pretty well contained, because even though the news hasn't changed, you can see that investor expectations, which are really the important factor, investor expectations and perception of where the economy is going is totally different. Next one we have is gold, which looks very positive, because you can see we do have a lot of sideways action, but then pretty much sustained improvement. And again, your basic idea is if you're above the green line, you want to buy the dips. If you're below the green line, you want to sell the rallies. So again, it's not perfect, but it gives you an idea of which end to be on. And at the end of the chart, you can see you're in pretty good shape. All right, this is, yes, good.
Where would you go online besides, if you had a stock that you wanted to look at, just to kind of get a chart similar to this, to see a trend?
Right. Bloomberg has point and figure charts. Stock Charts has point and figure charts. Those, depending on if you don't have access to Bloomberg, then Stock Charts is where I would go.
Lower right hand is a website. Lower right hand, stockcharts.com.
Stockcharts.com.
www.stockcharts.com.
So this is a $1 box size for gold. Now we're going to switch to the next one, which is a $2. So again, all we're getting is more history now, and we can see gold went through a very difficult time. And now as we get into 2009 also, Yeah, it's the same thing. It bottomed the same time as the market. But gold starts to bottom and turn around and go up. So I brought this chart just because it shows that the point and figure is not only for stocks, works on anything that trades. You want to put yields on here, bond prices, foreign currency, individual stocks, whatever you want, anything that trades. Any of these 4 chart types are good on any market. All you need is data that you can trust, essentially. And of course, liquidity counts for a lot, because if there's just one major player in a market, then whatever they do is just going to drive the chart and the price one way or the other. So some of the commodity prices, for example, are fairly illiquid, and you can get a lot of volatility. But in any liquid market, these 4 charting techniques will all give you helpful advice.
For gold, is it better to use the ETF or just go on the spot price?
As gold, do you want to use the ETF or the spot? And I don't think it matters too much. The advantage of going with the ETF is that it's the actual price. I mean, ideally, you'd probably go with the gold future. I think with any commodity, you'd rather go with the futures price than with the ETF. But, of course, the futures have a problem in that when one month expires, the next one comes on, and there's a difference in prices. So how do you, do you just have a gap down? Do you switch on the first day of the expiration month? It's, do you use the 3-month perpetual contracts, which are kind of an average? So again, the ETF may have an advantage.
How does the ETF incorporate the rollover?
Well, that's a big problem, and it changes from ETF to ETF. So, for example, the natural gas one, they owned so much of the futures that basically the regulatory authorities said you can't own that much, and they basically got screwed. But the GLD, I think, actually takes delivery.
Gold.
It's asset backed.
Gold. If you're trading an ETF that invests in futures, you give up a lot in transaction costs, an unbelievable amount. So you have to know what's underlying an ETF for sure. This is gold. So.
Right, so they're all different. The ETFs and the ETNs, well, actually the gold things are ETNs, they aren't ETFs. They're somewhat the same, but not exactly the same. So I would say if you're going to trade commodities, if you have any way to, you trade the futures and you learn how to trade the futures, which is a whole separate process, because the future comes into existence and then dies. And so you have to roll them over if you want a longer term position. But if you don't have access to those and you want to go with the commodities, then you just have to figure out sort of the ins and outs of your particular ETN. But at least it makes it easy to buy. It's easier than opening a futures account. It's easy to, the bonds don't have the same problem, seemingly don't have the same problem that the commodities do. So the TLT is a synthetic 20-year bond, seems to have no problems. The IEF is a 7 to 10-year bond. The SHY is a short-term bond. So you can trade those. They're very liquid. They trade millions of shares a day. So you won't have any trouble with that. The next one is Citigroup, just to drop out of a particular, out of an index and look at an individual stock. And again, with the point and figure chart, you can see how you stop at the same price level all these different times. That's $42.16, because this, I just used the average true range function, which is a nice starting point. And it said the average range for Citigroup was $1.24. So that's the box size I end up with. If you were doing this by hand, of course, you would never come up with a box size of $1.24. But what you're doing is you're trying to get an idea right off the bat of what the appropriate box size is, and the average true range gives you at least a starting point. So again, the end of 2002, Citigroup comes down, it starts to bottom, it starts to move higher. And in 2003, there's the March low. In April, it really starts to pick up some steam. And you can see it trades above the 50 column for the rest of 2003, 4, 5, 6, and most of 2007. So again, just your real basic rule, when you're above that longer term average on bar charts, people use a 200-day moving average or a 40-week moving average. That's kind of the standard long-term line. Same idea, when you're above that, you want to be buying the dips. When you're below that, you want to be selling the rallies or reducing equity exposure when you're on the wrong side of the long-term line and adding to equities on dips on the rising price side. And then you have this real nice key support level. What's a support level? It's where prices change direction. The prices are coming down, meaning that there's an imbalance on the seller side. There's more shares for sale than there are buyers, so the price has to come down to attract more buyers. And you can see that this is a high point, and then all of a sudden it becomes a low point, and then when it breaks down through there, now think about it, all these people, if you bought the stock, this is the beginning of October 2007. All the people that bought the stock going back to April 2006 now have a loss. And essentially, since it's a very competitive industry, once you have losses in your stock, it's just what's a reinforcement, a negative reinforcement loop. You keep waiting for it to come back up so you could sell it where you bought it, or at least better than today, right? So you buy something. I mean, this is just basic human nature, and even professionals get locked into it. Something starts to go against you, you want to sell it when it rallies. You just don't want to sell it on the way down because you're afraid that where you sell it will be the low. And then it'll turn around and go back up and you'll feel bad. And, you know, and you'll feel stupid. And plus, it's hurting your performance. So this is hurting your performance, but you'd like to sell it when it rallies because then, okay, you dump it, you get out, it doesn't hurt your performance as much. If this would come back up to this level again, you'd feel much better about things. But a lot of times in a strong directional market, you never get that chance. And that's where, remember we looked at the Krispy Kreme that was coming down, 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 and then there was a huge volume day at the bottom? That's where all the guys that are holding on to Krispy Kreme, waiting for it to rally so they can get out, say, okay, I can't deal with this anymore. I'm just getting rid of this thing, and that's the day. So that's what happens all the time. I mean, it happens over and over and over again. And again, if you're using even a fairly simple view of the market, when you've come down to the same level, 1, 2, 3, 4, 5, 6, 7 times you've come down to that level, and then you go lower, everybody for a year and a half has a loss in that stock. Everybody that bought it. That's not a good thing because they're all looking to unload it. And as often is the case, that was a previous point where it was a high spot. So it's kind of an inflection point for, again, balance of supply and demand. On this side, on the way up, people thought, wow, 42, Citibank's expensive. I'm not buying any more up above 40. And so it stops going up, comes down, up, down, up, down. But you can see, basically, the 10 column's still above the 20, the 20's still rising, and everything's above the 50. So you're still looking at this as a positive period where you want to add to the position. And sure enough, it gets back above 40, and it's like, oh no, I'm still not buying it there. But now it doesn't come down very far and breaks out to a new high and then consolidates a little and keeps going on up. Now it's the opposite. You've come down, you've broken these lows, you rally, you come down, test the low again, one more time up, but you can't make a new high anymore. The 10 and 20 have rolled over. The 10's coming down, the 20's rolling over, and now you drop below the 50, and it's just whoosh, the bottom falls out. So you want to get rid of it before that. That's sort of the key. And again, there's lots of different techniques to get you to the same point, but that's the point of technical analysis. Here's oil. Now this was a wicked advance and a fairly small top. So if you don't sell it until, until somewhere in here, well, you didn't get the top, as Professor Ross says. You didn't get the top, and you're not really happy about that. However, you sold it at 94, and it's going to 26. So in hindsight, you're kind of glad you sold it when you did. And this is really hard to do for a lot of portfolio managers, because if you base your decision process on fundamentals, you view price action in exactly the opposite way a technician does. When you're looking at fundamentals, most guys are looking to buy things when it's cheap. It's just like when I go out to buy a TV. I wait for the Labor Day sale to come, and then I buy it, because now I've researched the thing that I want, I like it, and now I'm trying to get the best price. This is exactly the way that the fundamental analyst looks at the market. So when it's
stocks are in televisions.
right, when it starts to come down, the fundamental guy immediately thinks this is now more attractive to me because the earnings are the same. Well, this is a commodity, but let's look at Citibank, same thing. The earnings are the same, the business is the same, but now it's cheaper. So the fundamental guy is going to look at this as an opportunity, but he doesn't really have the tools to know where the opportunity is going to go. And that's where the technician can work with the fund manager to help him recognize, okay, yeah, oil's coming down. You wanted to own it because it was going up. It's coming down, but it's too early to buy it. Don't buy it here, or else buy a tiny bit. If you can't resist, buy like a tiny position, because you're probably going to have more and more and more opportunities to buy. And if you have a really big fund manager, he can't jump in all at once because he's got too much money. He's going to move the prices. Everybody will figure out, oh, this guy's buying. Or if it's one of the big mutual fund houses, they tend to share research. They tend to come around to the same conclusions. So if you're a really big fund manager, you can't wait for the bottom and wait for it to really start to go up. But you don't have to buy your whole position here. Even if you have to buy a tiny bit all the way down, you're better off than if you bought a whole lot all at the same place. Yeah?
I was going to ask you, since you're saying the fundamentals are usually the opposite than technical indicators, so there's no really room to combine both together.
Well, I didn't exactly say that, so thank you for your question. The fundamentals and the technicals mostly agree. When you're going to have a really long directional trade, the fundamentals have to be good. We could go back to Citigroup just because it's a stock, but there's fundamentals for commodities too. The fundamentals, if the price is going to move in one direction for a long time, the fundamentals and the technicals will agree. The technicals are all very positive here. You can see everything's above the green 50 column average. The 10 column is above the 20 column the whole time. So this is telling you to stay long. Then where it starts to change, often the fundamental guy will have wanted to sell it down in here because to him it's already too expensive. And again, this is where the technical guy can say, look, it's too early to get out of this. If you want to sell a little bit, okay, sell a little bit, but don't dump your whole position because this is a very strong rising price trend. Then it starts to fall apart. And now that the technical indicators are all telling you shouldn't own any of this, you might want to be short, but a lot of the value indicators, because the economic stuff that the commodity fundamentals are based on would still be fairly positive, are telling you that it might be cheap. But what's going to change is that the economic stuff that govern the fundamentals are going to continue to deteriorate with sort of a lag, and so then it's going to justify. So over the course of the downtrend, the fundamental stuff changes so that for most of the move, probably the fundamentals and the technicals will agree. But at the turning points, that's where you can add value. And you can also help when something isn't a big directional trade, you can also help the guy at least try and buy it when it dips back towards support rather than buying it at the high, because nobody likes to buy it at the high. Makes you feel bad. So if it comes down a little bit and then you buy it, you're just happier. Your client is going to be happier.
Stocks are a leading economic indicator, and it's probably the best of all the leading economic indicators. Equities are probably the best record, maybe the second best to the yield curve. So a very good record of leading. And let's just say they lead by 6 months, to pick a number. So if the economy is going to have a 2-year expansion, even if the economists are bearish at the bottom and the stock market has turned, they're going to get bullish 6 months into it. And so the technicians, the economists, the fundamentalists are going to be bullish for a good deal of that move. But if it's something that's less than 6 months or so, then it's a little different.
Next is Goldman Sachs, and again, this, I just threw the Bollinger Bands on here just because, again, it's sort of a strange indicator to use with PNF.
How did you get the average true range in Bloomberg?
Sorry, the average range?
True range?
Oh, Stock Charts lets you pick it. It's got a thing for reversal size. You can set it yourself. You can have it use the average true range, and then you tell it how many days you want it to look back. Stock Charts gives you a lot of variability. You can pick whether you're using daily data, hourly data, 30-minute data, 10-minute data. You have all sorts of different choices. And you can look back however many days you want. I guess in this case I'm looking back 120 days and just calculating the average number of points per day. And it's just to give you an idea where to start. Otherwise you could start with one and you'll only get 1 month of data on your chart, so then you'll increase it until you get to the right point that you want. But this is a decent place to start.
We have a lecture on trends, we have a lecture on momentum, and we're going to go into a lot more detail on some of the things that Ken has been talking about. So if you didn't get it, we'll be doing a lot more of it.
Yep. That's it? Are we time-wise? Yeah.
Candlesticks, maybe lines would be more common. In what cases would you kind of want to focus more on this kind of a graph, I guess?
Sorry, because the others are more common than what?
Then say this.
Yeah.
I mean, when would you want to maybe use these moving averages as opposed to something that would be present?
Right. You're going to get into the indicators that you actually use on charts, and essentially you're going to find that it comes down to personal preference. Just like the top golfers in the world don't all use the same golf clubs or the same golf balls, but it's not that one club is really a whole lot better than the other. And like if Tiger Woods gives me his clubs, I'm going to shoot like him. So essentially you have to develop your own system for what works for you, what time frame you're looking at. A lot of people want to use the Bloomberg machines because you can get some of the newest indicators, like the DeMark indicators on there. And otherwise, we focused on point and figure here because it's hard to find those charts. You're going to find a ton of examples on bar charts and especially candlestick charts as you go forward. So we just tried to flesh it out since it's at least in my previous life, it was my specialty. So, other questions? Yeah.
Since the moving averages are heavily weighted by previous data looking forward, how do you decide where it's a point of reflection, or do you have some strategy as to seeing forward into the future to say these are confirmations? You have three data points each time your stock is going to fall. How do you?
Right. So question about moving averages. Everything we've looked at here today are simple moving averages. They're just equal weight, all the past data. A lot of people prefer more front-weighted, like an exponential data. There are all sorts of techniques you can use for moving averages, including centered moving averages that move the data forward from where it is. And beyond that, there are two main classes of indicators. There are trend following indicators, where moving averages are a major component, if not the basic component. And then there are all kinds of oscillators that try and identify when you're way up extended or when you're down extended, overbought as they call it, or oversold. And in essence, if you're just using one type of indicator, either the trend following indicators or the oscillators, you tend to get yourself in trouble. So what you kind of need to do is integrate the overbought, oversold type oscillators and some trend following as well. Because the problem with the oscillators are that they will get into the idea is with the oscillators, when they get very high, you shouldn't be a buyer. And the idea is that when they get very low, that's where you should be a buyer. But when you're in a long rising trend, they never get very low. They get very high, and maybe you don't want to buy there, but if you're waiting for them to get very low, they're never getting there. So you'll never have a buying opportunity. So if you only relied on the oscillator without the trend idea, then you don't really have the nuance to say, okay, when this is at 80, I don't want to be a buyer, but I'm not waiting for it to get to 20. When it gets down towards 50, or whenever it comes down and starts to turn back up again, that's my inflection point where I want to go long. But if you're in a downtrend, then you're oversold all the time. Every low you're oversold, and you never get overbought. So if you're waiting for something like stochastics to get above 80 or RSI to get above 70, it's not getting there. You could go years between those long, if you're in a long downtrend, you're never getting to 80 on the upside. You're never getting to 70 on the RSI. So you have to adjust the oscillators and how you weight them in your action points based on what the trend is, and that's where the trend following indicators come in. They'll set your parameters for the oscillators, and you end up combining the two.
Mr. Tower talked about RSI and stochastics, and we get into those tools in the momentum lecture. Out of time. Thank you very much.
All right. Thanks a lot. Thank you.
If anybody didn't give me your homework, turn your phone, please give it to me.